If your plan is to invest in dividend stocks and one day live completely off the income, then you need to understand the real numbers first. Because from the outside, dividend investing sounds almost perfect. You buy shares of strong companies, they pay you cash, and that money keeps coming in, whether you are working, sleeping, or spending time with your family. That is the dream. Passive income, financial freedom, a portfolio that quietly pays your bills. But here's the part most people do not think about deeply enough. Dividends only become life-changing when the amount of money invested is large enough. A stock paying you a small percentage every year can still be a good investment, but it may not create enough income to live on unless your portfolio is already very big. So let's start with the most important formula. You take the amount of passive income you want each year, and you divide it by your dividend yield. That gives you the amount of money you need invested. For example, let's say you want $50,000 per year in dividend income. That number sounds simple, but the amount you need invested depends completely on the yield your portfolio produces. If the yield is low, you need a much larger portfolio. If the yield is higher, you need less money invested. But this is where investors have to be careful. A higher yield does not always mean a better investment. Sometimes it means more risk hiding underneath the surface. So before chasing big dividend numbers, you first need to understand what the math is really telling you. To see how powerful this formula is, let's use a very familiar company as an example. Apple. Now, this is not saying you should put your entire portfolio into Apple stock. That would not be realistic for most people. But Apple is a useful example because it shows how a great company does not always mean a great source of dividend income. At the time of the original numbers, Apple offered a dividend yield of about 0.39%. That means for every $100 you had invested in Apple, you would receive about 39 cents per year in dividend payments. So if your goal was to generate $50,000 per year in dividend income from Apple alone, you would need a massive amount of money invested. In fact, you would need well over $10 million worth of Apple stock. That sounds ridiculous, but mathematically, that is what a very low dividend yield does. It forces you to own an enormous portfolio before the income becomes meaningful. Now compare that with a company like Pepsi. Pepsi is also a major brand, but its dividend yield was much higher, around 3.7 to 3.8%. With that kind of yield, the amount needed to generate $50,000 per year drops dramatically. Instead of needing more than $10 million, you would need around $1.3 million invested. That is still a lot of money, but it is a completely different reality. This is why yield matters so much. And if you look at Dividend Aristocrats, which are S&P 500 companies that have raised their dividends every year for at least 25 straight years, their yields often fall somewhere between 1 and 4%. And from real dividend portfolios, many investors usually land around the 2.5 to 3.5% range. At that range, to generate $50,000 per year, you would likely need somewhere around $1.4 to $2 million invested. So the dream is possible, but the numbers are much bigger than most beginners expect. At this point, you might be thinking, if a higher yield means I need less money invested, why not just buy the stocks with the highest dividend yields and get there faster? That sounds logical at first, but this is where dividend investing becomes dangerous for people who only look at the income number and ignore the business behind it. A high dividend yield is not always a sign of strength. Sometimes it is a warning sign. Sometimes the yield looks high because the stock price has fallen hard. And when a stock price drops sharply, the dividend yield can appear attractive even if the company itself is under pressure. A perfect example is 3M. In the original version of this topic from 2022, 3M was used as an example of a strong dividend company. At that time, it was a dividend aristocrat and had raised its dividend every year for 66 straight years. Its yield was over 4%, and it looked like the kind of company many income investors could trust. But then, in 2024, 3M cut its dividend. Just like that, 66 years of dividend increases were gone, and the company was removed from the Dividend Aristocrats list. And 3M was not the only one. AT&T, another high-yield example, cut its dividend by 46% in 2022. Walgreens also cut its dividend after more than 40 years of increases. This is the lesson. A company can have a long history of paying dividends, but that does not guarantee the payment will last forever. Every dollar a company pays out as a dividend is a dollar it is not using to reinvest in growth. And if the business stops growing, the dividend you were counting on can disappear. So if even companies with decades of dividend history can cut their payouts, how should an ordinary investor protect themselves from chasing the wrong kind of income? So what should we actually do as investors? To answer that, we have to look at the reality most people are starting from. According to the Federal Reserve Survey of Consumer Finances from 2022, the median net worth in America was around $193,000. And if we are being generous and adjust that number higher to roughly match inflation, maybe we could estimate it at around $217,000. Now imagine taking that entire net worth and putting it into a dividend portfolio with a 5% yield. That would generate about $150 per year in dividend income. That is not nothing, but it is also not enough for most people to live on. And that is the hard truth. For many investors, reaching a $1.5 to $2 million dividend portfolio is extremely difficult. If dividend income is your only strategy from the beginning, you may actually be making the journey harder than it needs to be. This is where total return investing becomes important. Vanguard published research called Total Return Investing, an enduring solution for low yields, and the main idea is simple. Instead of focusing only on dividend income, investors may benefit more by focusing on the total return of the portfolio. That means dividends, price growth, diversification, and long-term performance all matter together. When you concentrate too heavily on dividend stocks, your portfolio can become tilted toward more defensive sectors like consumer staples, healthcare, and utilities. At the same time, you may become underweight in areas like consumer discretionary and technology, which can play a major role in long-term growth. That does not mean dividends are bad. Dividends can be a useful part of a portfolio, but if you focus only on the income, you may miss the bigger picture, the total growth of your money over time. So if dividend investing has opportunity costs, especially when you are younger, what is the better approach? If you are under the age of 35, it usually makes more sense to prioritize growth instead of dividend income. The reason is simple. When you are young, you have time. If your investments fall 20 or 30%, you still have decades to recover. That time gives you the ability to take on more risk and focus on building your capital base as quickly as possible. And that capital base matters more than most people realize. A $10,000 portfolio with a 4% dividend yield only pays $400 per year. That income is real, but it probably will not change your life. At that stage, the bigger goal is not to pull out small amounts of income. The bigger goal is to grow the portfolio into something powerful enough to matter later. That is where compound growth becomes so important. The faster you build your base of capital, the sooner your money can start working harder for you. But as you get older, the strategy can begin to shift. If you are closer to your late 30s, your 40s, your 50s, or beyond, you may naturally want more stability and more income inside your portfolio. That is when dividend-paying ETFs like SCHD or VYM can start to make more sense. Maybe you begin with 5 or 10% of your portfolio in dividend-focused holdings. Later, depending on your risk tolerance, your time horizon, and what you need from your money, that allocation could become much larger. The key is not to treat dividends as an all-or-nothing decision. They can be part of the plan, but they do not have to be the entire plan. Now, especially in 2026, there is one more thing investors have to think about. A 3% dividend yield from a stock is not the only way to generate income anymore. Depending on the current interest rate environment, high-yield savings accounts and treasury bonds can offer similar income without requiring the same stock market risk. That matters because a dividend stock can fall in price, cut its dividend, or underperform for years. Treasury bills, by comparison, are much lower risk. So if your goal is income right now, you should not ignore the options the market environment is giving you. But there is another part that sounds boring and is actually extremely important. Taxes. If you are receiving dividends, those dividends may be taxed either as ordinary income or at capital gains rates. For long-term investors who buy and hold, many dividends are usually qualified dividends, which can receive more favorable tax treatment. And if you hold dividend investments inside a Roth IRA, those dividends can potentially grow tax-free inside that account. So the final rule is simple. Take the dividend income you need and divide it by your dividend yield. If you need $40,000 per year and your portfolio yields 5%, then 40,000 divided by 0.05 equals $800,000 invested. That is the formula to remember. Dividend investing can absolutely be useful. It can create income, stability, and confidence as you get closer to retirement. But if you are investing for the long term, especially if you are still young, growth should usually come first. Build the capital base. Let your money compound. Then when the time is right, dividends can become part of a much stronger plan.